Imagine going to the grocery store to cook a big dinner. You could buy 500 individual ingredients, or just grab one pre-packaged meal kit. Same result, but one approach is way simpler. That's exactly what an ETF does for investing. ETF, or Exchange Traded Fund, is a basket that holds many stocks at once. Inside this basket, you might find Apple, Microsoft, Google, Amazon, and hundreds more. When you buy just one share of the ETF, you instantly own a tiny slice of every stock inside. But how do we know one share is actually worth? That's where NAV comes in. NAV stands for net asset value. It's the total value of everything inside, minus any liabilities, divided by the number of shares. Let's say our Tech1 ETF holds Apple worth $1,500, Microsoft worth $3,000, and Google worth $1,000. That's $5,500 in assets, minus zero liabilities, divided by 100 shares. Each share is worth $55. Most ETFs follow a recipe called an index. Think of the index as the recipe and the ETF manager as the chef. The chef's job is to match the recipe exactly. The S&P 500 holds about 7% Apple, 7% Microsoft, 6% Nvidia, and 497 other companies. This is called market cap weighting. Bigger companies get bigger slices, but no single stock dominates. The vast majority of the fund, about 80%, is spread across hundreds of other companies for true diversification. Here's something important about market cap weighted ETFs. They adjust automatically. If Apple and Microsoft both start at 7%, and then Apple stock doubles in price, what happens? Apple's weight automatically increases to about 12%, while Microsoft's drops to 6%. The ETF doesn't need to trade at all. Trading only happens when companies are added or removed from the index. This keeps costs low. Now here's the really clever part. What keeps the ETF price aligned with its true value? Special traders called authorized participants act as arbitrageurs. They keep prices honest. If the ETF trades above its NAV, say $56, the AP buys the underlying stocks for $55, creates new ETF shares, and sells them for $56. Free profit. If the ETF trades below NAV, say $54, the AP buys cheap ETF shares, redeems them for stocks worth $55, and pockets the difference. This arbitrage mechanism keeps the market price glued to the true value. Let's look at some real ETFs you've probably heard of. SPY tracks the S&P 500, America's 500 largest companies. QQQ follows the NASDAQ 100, mostly tech. And VT covers the entire world. Look at these expense ratios. SPY charges 0.09% per year. QQQ charges 0.20%. VT is just 0.07%. Compare that to the average mutual fund charging 1 to 2%. ETFs are over 20 times cheaper. ETFs have 3 major advantages. First, low cost. Those tiny expense ratios compound over decades and save you thousands. Second, tax efficiency. The creation and redemption process avoids triggering capital gains taxes until you actually sell. So remember, ETFs are baskets of stocks you can trade on the exchange. Market cap ETFs adjust automatically, and arbitrage keeps prices fair. They're low cost, tax efficient, and incredibly simple to use. One trade, instant diversification.